For the past 4 years, news cycles have been spinning faster than many of us can remember. The COVID-19 pandemic, geopolitical tensions, new fiscal policies.
Most investors weren't experts in geopolitics in the past. Today, maybe in addition to people who have, an MBA or a finance degree, we need a few more people with political science degrees around the table.
I'm Alex Zabjek, the host of Absolute Returns. In this inaugural episode, we'll hear from Mark Wiseman, former chair of the board for AIMCo. He joins me to discuss this time of transformation. And then,
things are moving too fast. Canada is falling too far behind. Canada is a leader in AI research, but a laggard in the application and usage of AI.
Artificial intelligence is poised to change the way we work. Scholar and author Dr. Ajay Agrawal discusses how AI may disrupt industries as the companies powering a new wave of AI challenge the status quo. And it's been 2 years since the Bank of Canada started implementing a series of interest rate hikes. We check in on the latest economic indicators. Welcome to Absolute Returns. In the second week of April, the Bank of Canada announced it would keep its overnight interest rate at 5%. It's likely not the news Canadians were hoping for, as they feel the pinch of higher prices due to inflation and higher interest rates. To break down the numbers behind the central bank's decision, I spoke to AIMCo's chief economist, David Tremblay-Frenette. I started by asking his reaction to the latest rate announcement.
We are not surprised, as we at AIMCo have penciled in the first Bank of Canada policy rate cut to occur in June of this year. And we believe that at this stage, it's perfectly normal for the Bank of Canada to prefer waiting for a bit more confirmation that inflation, both the headline as well as the core measure of inflation, are definitely on a downward path.
And we know that these rate hikes are meant to ease growth and that in time that will eventually ease inflation. Can you describe how has inflation really progressed over the last year or so?
So right now, as of the latest data released, on an annual basis, inflation has slowed to around 2.8%. So that's against expectation of an increase of a bit more than 3%. So we're definitely heading into the right direction, but it's still going to take quite a bit of time before getting there, reaching that comfort level. The target range for the headline inflation on the part of the Bank of Canada is between 1% and 3%. So the fact that inflation has already slowed to 2.8% on an annualized basis is definitely a good sign if we put ourselves in the shoes of the Bank of Canada governor.
So if we are sort of within that 3% range right now, is that even across all of the factors that we look at when we consider inflation?
The one thing that it still is much higher than what it needs to be for the Bank of Canada to be comfortable is shelter inflation, which incorporates like the inflation for rental accommodation as well as for houses that are owner occupied, in other words. So the shelter inflation in Canada is still running upwards of 6% on an annualized basis. And that's definitely a little too high for comfort. But the flip side of that is that the other categories of the inflation basket for Canadians is heading in the right direction, such as clothing and footwear. Even food prices is slowly but surely decelerating. But truth be told, for Canadians, while the pace of inflation might be decelerating, the reality is that the level of prices themselves, so what people actually pay from 1 month to the next, is still much higher than prior to the pandemic. So that's why Canadians don't feel truly at ease with the general level of prices in the Canadian economy.
I was going to say, it does seem as though food prices still seem very expensive compared to what we might remember them even a couple of years ago, even if, as you said, that rate at which they're increasing is slowing down just a little bit. Can you give us a real targeted look at what it's like specifically in Alberta right now?
So in Alberta, inflation has been sitting on the higher side of things, even compared to some of the other provinces. Part of it can be explained by the fact that certain economic sectors, such as even in the oil and gas industry and even within the public sector, wage inflation has been quite robust. There has been a lot of demand for workers in the province of Alberta. Various employers have been, I would say, I wouldn't deem them as being kind, but rather in tune with inflation trends and have agreed to wage inflation or wage increases rather that have been commensurate with what people have been experiencing on the ground. It's a similar situation in other provinces. It's just that the exact composition of which sectors are actually driving the show in different provinces and the types of wage increases that have been agreed upon by the different firms and companies and even the public sector makes up for differences here.
I think for a lot of everyday Canadians, when they think about higher interest rates and higher inflation, they're really equating that to higher shelter costs, whether it's a mortgage or rent payments. And I am just wondering, as we enter into what's broadly agreed to be a higher interest rate environment, what is that going to mean for organizations rather than just for individuals?
Now it seems like interest rates are no longer going to be at the zero interest rate level. And that's a big change for small and medium-sized businesses in particular, but also for large corporations. And really, when some of them are going to have to renew some loans, they have to really think through about some of the consequences in terms of the profit margins that they are very likely to experience or lack thereof. And that's why it has an impact on the labor market down the road as well. Am I going to hire more bodies to produce goods or services, or am I happy with the current labor force, knowing that I've got to pay that labor force a tad more than it used to be as well? And really, if there's a risk, it's the risk that since most employment in Canada comes from small and medium-sized businesses, we're definitely monitoring very closely the mood as well, the sentiment across small and medium-sized businesses. It's going to be a real indicator of things to come.
So what if we move up to an even bigger organization, like an institutional investor like AIMCo or any of its peers? These are organizations that invest in multiple asset classes, be it real estate and public equities, bonds and infrastructure. They invest a lot of money on behalf of their clients, and they have liabilities to those clients as well. What does it mean for those organizations to be operating in a higher interest rate environment?
So when a large institutional investor acting on the behalf of pension fund beneficiaries, for instance, is facing an environment where interest rates are much higher than what they used to be, this actually provides a great match for the very long-term liabilities that they are facing. Basically, those long-term liabilities are the amounts on a regular basis that pension funds have to pay to their beneficiaries. So there's already a big portion of what they are liable for that can be achieved by investing perhaps a little bit more into those higher return bonds. And that provides also some degree of added diversification in comparison to the rest of the portfolios that they are typically invested into, namely stocks, but also real estate, infrastructure, etc.
And what about the inflation side?
On the inflation side, some asset classes like real estate or infrastructure provide cash flows and revenues that partially adjust with inflation. A good example of that would be a toll road. Well, typically the contracts that one institutional investor is getting out of investing into a toll road gets adjusted over time via inflation. So the fact that inflation might be a bit higher also in the end can produce somewhat higher returns for large institutional investors. So not everything is the doom and gloom. Rather, it becomes a bit of an equilibrium whereby you get some benefits from having a higher interest rate environment and higher inflation environment to some extent at the margin, because the different asset classes react differently and in many cases positively to some of those trends.
It's good to hear someone say that it's not always doom and gloom, because sometimes it can feel hard not to feel that way when you're either looking at maybe your mortgage payment or your rent payment right now. Thanks so much, JD.
It was a pleasure. Thank you for having me.
In the past year, AI has been in the spotlight for investors who saw public markets take off, largely due to the so-called Magnificent Seven. Those are companies like Amazon, Nvidia, and Apple, seen to be driving an AI boom, and for people who are using ChatGPT to help them at work. But our next guest studies in depth how AI may disrupt our work.
My name is Ajay Agrawal. I'm a professor at the Rotman School of Management at the University of Toronto, and I study the economics of artificial intelligence. When an economist attempts to understand a technology, that we approach it by asking a question, and the question is the same question no matter what the technology is, and that is, what does this reduce the cost of? So, for example, the semiconductors at the heart of Silicon Valley reduce the cost of arithmetic. They make arithmetic cheap. The internet reduces the cost of search, reduce the cost of the digital distribution of goods and services, and reduce the cost of communication. In the case of artificial intelligence, it reduces the cost of prediction. It makes high quality prediction cheap.
You may already have heard of Dr. Agarwal's work. He's the co-author of 2 acclaimed books, Prediction Machines and Power and Prediction, and he's a founder of the Creative Destruction Lab, which helps early-stage science and tech companies scale their work. This focus on innovation, entrepreneurship, and economics all contribute to his analysis of AI and the future of work.
And so our question is always with AI, what happens when prediction becomes cheaper? And it's pointed at different applications.
Dr. Agarwal explains that when prediction becomes both fast and cheap, it can influence industries in ways that are both small and transformative. Institutional investors are watching these trends closely. As large, data-driven organizations, they may embrace technology that can solve coding problems or speed up the process of analyzing market reports. And as large-scale investors, they're watching for opportunities to provide capital for new ways of doing work and the technology required to make that happen.
So in some cases, the impact can seem small, even if it increases productivity. So let's say in a bank, where we take out some old predictive analytic tool and we input a more high fidelity prediction AI to predict fraud. The workflow stays mostly the same. The bank becomes better at detecting when a transaction is fraudulent. And so, everyone goes about still doing their normal jobs, but the overall performance of the bank goes up. So that's quite trivial. Or imagine a navigational AI that predicts the best route between 2 places like Google Maps or Waze. Let's say if taxi drivers use that could improve the productivity of the taxi driver by helping them, navigate a slightly better route. So that's a minor change. But then you can also have a major change and like a disruptive change. And an example that all the listeners will be familiar with is Uber. Uber would not be plausible without a navigational AI. You can imagine if the first time you ordered an Uber, a stranger pulled up in front of your house, you climbed into their car, and 3 minutes in the ride, they pulled over the side and took out a map to figure out how to get you to where you're going. You'd never take another Uber. You say, I'll stick with the pros. But that navigational AI enabled untrained people to drive like a pro. And what that did was it transformed transportation. For example, in the United States, before Uber, there were about 200,000 people that drove taxis and limousines before Uber. Today, there's about 4 million people that drive for Uber. Imagine if each of those drivers brings, let's say, on average, a $25,000 car onto the road. $25,000 per vehicle times 4 million drivers, that's $100 billion of CapEx brought into the transportation system. That is a real system change to the transportation system in the US in introducing Uber. So I think some of these AIs, they'll impact productivity, but to the casual observer, it won't seem that different. But there are others that will do a complete system redesign, like the AI will unlock a system redesign, and that will have quite big impacts, as we've seen with something like Uber.
I know that in your recent book, you did actually look at the number of companies that are scaling up their use of AI, and that it's actually lower than one might expect, sort of at this period that we're at. Why do you think that is?
Well, first of all, that book came out just before ChatGPT was released, and that changed a lot of things. So I think that ChatGPT came out in November of 2022. That Christmas, and in Q1 of 2023, a lot of people were at home over Christmas trying it out, and in Q1 came back to work, were trying it out personally, writing poems, doing various things on ChatGPT. By Q2, Q3, Q4 of 2023, a lot of the companies we met were starting to experiment, run POCs, proof of concept, inside their organizations. Some companies were having hackathons. They were trying various things to just create an environment for ideas and testing. But POCs don't really have much impact on enterprise. It's not until they move into production. And we are just now at the very beginning stage of large enterprise starting to actually implement AI systems in production in the companies. I suspect many of your listeners are just for the first time starting to use these at work, for example, tools that come through their Microsoft Office suite and things like that. So it's just entering the commercial domain. I suspect by the end of this calendar year, 2024, many large enterprises will have a small handful of AIs in production.
And is it then a matter of coming up with the ideas, or is it a matter of having the leadership that says we need to come up with the ideas? Like, where do you think is going to be the starting point for seeing some of those major changes within this industry?
Yeah, that's a great question. I think you said it. It's leadership. So I think right now, given the vast range of capabilities of AI, that every industry in Canada is subject to a 20% productivity increase over the next 24 months. So in other words, every CEO could ask every one of their direct reports to come back in 3 months with a plan for how they are going to generate a 20% productivity gain over the next 24 months. We've just launched a new initiative to help Canadian companies increase their adoption of AI. And so the program's called Putting AI to Work. And that's how it starts. We start off with helping the companies prioritize, of all the things they could use AI for, which are the things that will give them the biggest bang for their buck. So for each unit area within inside the organization, what application gives them the greatest lift, and with a target of 20% productivity over the next 24 months. And they come in cohorts. So for example, there might be an airline in this cohort with a bank, with a retailer. And so first part is picking which AI to focus on. There's AI for sales, there's AI for customer service, there's AI for preventive maintenance, there's AIs for procurement. So you can go right down the list, and there's lots of different solution types. So first they prioritize what they're going to start with. Then we bring in a small number of vendors to explain how their particular solution works. And so they can listen to the different solutions, and they can choose one that they're going to try. And then there's peer sharing. Basically go through this program. They meet every 2 weeks online, and they peer share with each other. So they say, oh, this is what I'm trying. Here's what's working. Here's what's not working. And the others can learn from each other. Because the idea is we don't have time to be press to everyone to kind of keep it in-house and be secret. Things are moving too fast. Canada is falling too far behind. Canada is a leader in AI research, but a laggard in the application and usage of AI. And so we're just trying to speed things up.
You mentioned some companies earlier that have already been transformed by AI, something like the transportation industry when it comes to Uber. But when you look at something like the insurance industry that has that tremendous predictive abilities, it might not have changed as much as one might have thought. Can you talk a little bit about that?
Given that artificial intelligence is effectively just computational statistics that does prediction, and there's no industry that is more predicated on prediction than insurance. That whole industry is about prediction. That industry would be the very first one to be overhauled with AI. But it's also a very regulated industry. And there's a lot of regulatory barriers that prevent insurance companies from using AI for certain type of applications, including the way that they measure risk and underwrite risk.
I believe I've heard you say before, if an insurance industry could figure out whether you have a likelihood of a leaky pipe in your house, wouldn't it be just better to tell you about that so you could do something to prevent the leak rather than just to wait for the claim in the first place?
Yes, that's a great point. The insurance industry has, for the life of the industry, the business model has been about predicting the likelihood of some kind of catastrophic failure and then underwriting that risk and then paying a claim when the bad event happens. And now, due to the enhanced ability to make these predictions, but also a significant drop in the cost of putting sensors into things to collect high fidelity data in real time, that rather than an industry that's main value is to help restore people's finances when they face a catastrophic failure, that the model you can imagine shifting to instead providing guidance to help people prevent that failure in the first place. And so we're already seeing some green shoots of that. So for example, Tesla's car insurance, you get these monthly reports and they give you your safety score. The things they measure them because they view them as good predictors of whether you're going to have an accident. But they tell you every month, this was your number of aggressive left turns, your number of aggressive brakes, your frequency of tailgating, getting too close to the car in front of you. And so it shows you how you got your safety score and therefore gives you guidance of how you can be a safer driver the next month. And if you're a safer driver, then your premium goes down. So you get these economic incentives to reduce your risk. And it seems to me like that's the obvious direction that the whole industry moves, is rather than being primarily about mopping up after a catastrophic failure, it becomes more about helping their customers manage their risk before the catastrophe happens.
In which case it would seem to be an entirely new industry that we'd be considering.
Yes, it would be a new industry with a different business model. It's still there to manage risk, but rather than mopping it up after it happens, it's there as a preventative guide.
What if you don't work for a big organization? Maybe you don't have an R&D department. Maybe you don't have anyone at the organization who is thinking about AI at all. Do you have any advice for individuals who might just be thinking about how can I implement AI or bring some AI into my daily tasks to make myself more productive or to maybe change the way I approach my work?
That's a great question. So if you were to ask me that question 3 or 4 years ago, I would have said it's very hard, because in order to build an AI solution for your work environment, and let's say you're at a very small company or a not-for-profit or something, you needed data scientists, you needed a lot of data and all of that stuff to make an AI model. Today, that's not true. Today, there are off-the-shelf AI solutions, some of which are very affordable. That program I described, putting AI to work, there are cohorts set up for that for very small mom-and-pop companies and not-for-profits to help them figure out in their organization for their jobs what are the low-cost, simple AI tools that they can use that will, help them increase their productivity. So today, just like everyone can use ChatGPT, there are some very accessible tools, even for very small businesses with people that don't have any technical background and have very small budgets.
To go back to maybe to the very first question we talked about when we were discussing about lowering the cost of prediction, I know you've said in the past that humans aren't always good at figuring out what they might be able to do if they have more information to make those predictions. Do you think that that is still maybe a major block or a major point where we have to rethink things, or we have to expand our minds a little bit more, or maybe you just have to hear what your friend is doing to see if there's something that AI can do to change your workflow?
I think you just said it in the last part of your sentence, which is, in some sense, it's really just a lack of imagination. There's so many things we can do with this. This will be a period of a lot of experimentation and sharing. And that's exactly why, in the beginning at the Creative Destruction Lab, we were helping, one company here, one company there. And then we realized, wait a minute, this is moving so fast that doing this one at a time is not efficient. We need to do this in groups. And so putting people together in groups who have sort of similar aspirations, they might come from different industries or might be in different organizations. But once they see what others are doing, they get inspired. And so they can learn specifically, oh, I'll do the same thing you're doing. Or they might get inspired and say, well, I can adapt that or do something different in my environment. Some of the outcomes of experimenting with AI are good, but some are not good. And so one of the kind of norms that we have in this CDL program is to share unintended consequences. Almost surely everyone will face some unintended consequences. And so the norm is everyone contributes at least one unintended consequence to the group. And so that way we learn from each other's mistakes faster. Otherwise everyone will have to go through learning that themselves and go through 10 unintended consequences, as opposed to, okay, everyone contribute one to the pot. And if there's 10 of us there, we learn all 10 from each other's experiences.
That sounds like a pretty good life lesson, not only an AI learning lesson.
Yeah.
Dr. Ajay Agrawal, thank you so much for joining us today.
My pleasure, Alex. Thanks for having me.
Quick question. What were you doing 1,000 days ago?
Viral pneumonia has hit central China's Wuhan city. Authorities have reported 27 cases in total.
It's a new type of coronavirus.
Tonight, U.S. cases of coronavirus more than doubling.
COVID-19 can be characterized as a pandemic.
It might seem like those headlines aired in another lifetime, but our next guest says we can't ignore the changes that have happened since. He's Mark Wiseman, former chair of the board at AIMCo. He stepped away from that job in December and joined me recently to talk about world events and how he believes they've affected markets and, as a result, the work of institutional investors. Mark, welcome to the podcast.
Delighted to be here. Thanks for having me.
You joined AIMCo in June 2020, 3 months after the start of the COVID-19 pandemic. And you've described the time since then, the 1,000, at this point, maybe 1,300 days, as transformational. Why do you say that?
So much has changed in that reasonably short period of time. And it's barely, if even a blink of an eye in human history. But think about the last 1,000 days and how much has changed around the world. 1,000 days ago, as you mentioned, we were in the depths of a global pandemic. 1,000 days ago, there had not been major decoupling yet between China and the West. 1,000 days ago, we didn't have a war in Ukraine. 1,000 days ago, we didn't have a war in the Middle East. 1,000 days ago, we didn't have inflation and substantially higher interest rates. The outcome of the last 1,000 days is going to have a very profound impact on the world, and specifically for AIMCo on the way that the organization thinks about investing on behalf of its clients.
That was going to be my next question, is just what does all of that mean for investors?
First of all, obviously, we're in a higher rate environment, higher for longer. And that means we have to think differently about asset allocation. We have to think about duration in our portfolio. When I say duration, that means risk to interest rates going up or down, the sensitivity of the portfolio going up or down as a result of changes in interest rates. And that doesn't just affect bonds, but it affects things like infrastructure. It affects things like the valuation of real estate. It affects the valuation of equity markets. So all of those things from an investment perspective is sort of the traditional way we have to think about the rate environment that I talked about earlier. But in addition, those geopolitical effects can have big knock-on effects in terms of portfolio valuation, how you allocate to your portfolio, where you're going to make a return, and most importantly, not just return, but the perceived and real risk of assets in a portfolio. So in the last 1,000 days, all of these things, the calculus around how one thinks about this and how one calculates it has changed fundamentally. And a lot of those things are things that, as investors, we didn't have to think about a whole lot for the last couple of decades, right?
And again, though, how do you deal with those geopolitical risks? Like, diversification is always important in investing, but does that principle apply any differently in a world undergoing a period of real upheaval?
As many have said, diversification is the only free lunch in investing, and I think we have to continue to diversify our portfolio across asset classes and also across geographies. But it means that we have to develop and hone different skills as investors. So being able to value a company is a certain skill. We can build a spreadsheet, we can look at underlying cash flows, we can make some assumptions about supply and demand for the company's products or services. But now we also have to think about, well, wait a second, the company happens to be operating in Taiwan. What happens and how much additional risk do I have if something changes in the relationship between Taiwan and China? Those things were always in the back of our mind, but they never seemed real. Now they're much more real and they have an impact on valuations. Even the US election is a good example. If you're operating a company that, let's say, is selling goods or services into the US, what does a Trump presidency mean to tariffs, for instance? And how is that going to change those underlying cash flows of the company and therefore change your valuations? Most investors weren't experts in geopolitics in the past. Today, maybe in addition to people who have, an MBA or a finance degree, we need a few more people with political science degrees around the table.
I want to go back to something you mentioned in your first answer there, the idea of we saw a major decoupling between China and the West, or the United States in particular, during the pandemic. There has been an emphasis since that time on domestic production capacity and supply chains, specifically about the Inflation Reduction Act in the U.S. What are the consequences of this, redirection in hyperglobalization?
Yeah, well, look, the big impact has been inflation, and we've seen that in our individual lives. Things have gotten more expensive. Essentially, for the last 30 years or so, we've had a deal in the West with China. It's not been sort of an explicit deal, but it's been quite implicit. And the deal has been we've exported inflation to China because they had low-cost manufacturing. And as a result, we got goods and services at a low cost on our end, and the Chinese were able to grow their economy substantially and bring literally hundreds of millions of people out of poverty. That was the deal. That deal is now unwinding, and as the deal unwinds, what's happened essentially is that we've got inflation coming back to us in the West, and the Chinese have lower growth. Now, it's much more complicated than that, but sort of in simplest terms, that's what's happened. We've also realized through the pandemic that resiliency in supply chains is very important. So if we have a single source of supply for some input to our products, we recognize that actually we're at risk. So now I've got to think about multiple sources and the additional costs associated with that. That's most obviously in areas like microchips, but it's also true of really simple things like zippers, where people were sole sourcing zippers from China. Now it turns out if you can't get zippers from China, I better think about having an alternative source of supply.
I want to switch the direction of the conversation a little bit here. What do you see as the role of institutional investors to play in the energy transition?
My personal view is that the role of an institutional investor like AIMCo or like some of the other Canadian pension funds, for example, is to maximize risk-adjusted returns for their beneficiaries. The role of the institution, by and large, is not to change the world or take a policy view, et cetera, et cetera. So if you take the view that the role of a long-term investor like AIMCo is to maximize long-term risk-adjusted returns, the question then becomes, how can we as an investor profit from the energy transition? I think the energy transition has to take place. I think we all realize that there is a finite amount of fossil fuels in the world. There is also the need to decarbonize our environment and reduce greenhouse gases. Government is seized with that. Government is putting in rules, regulations, subsidies, etc. And so given the finite amount of resource and given government's role and the consumer's role in reducing carbon in our atmosphere, The opportunity, and I think it's a huge opportunity, is for investors to take advantage of that situation to help to finance that transition to make a excellent risk-adjusted return and enhance the portfolio through being diversified, through making a good return on those investments, et cetera, because those investments are capital heavy. And so if you're a provider of capital like AIMCo or like another pension plan or a sovereign wealth fund or an insurance company, if you're a provider of capital into the system, into the market, you should be able to make a substantially positive risk-adjusted return. So it's a big trend, right? I happen to believe, and I think a lot of people now share the view, that energy transition will be a massive opportunity to deploy capital and make an excellent return. And that's how I think we have to think about it.
Let's go back about 1,000 days again, or 1,300 days now, when you first joined AIMCo. Did you have a goal in mind when you first joined the board?
I don't think I had a specific goal in mind. I'm a big believer in the idea of having a public asset manager. I'm a big believer in sort of economies of scale that come from an organization like AIMCo. And obviously AIMCo had gone through some challenges prior to my arrival. And so my goal was very simple, which was to help the province of Alberta and the management team at AIMCo, based on my experience, to rebuild the trust of our clients and, frankly, the government of Alberta and the people of Alberta in AIMCo, because the model of a scaled public asset manager makes a lot of sense. It's really important. Maintaining that confidence is ongoing and constant project and will continue to be for AIMCo for the years ahead.
Well, thank you so much for joining us, Mark. I really appreciate it.
It's great to be here with you, and I'm going to be watching closely, and I wish all of my friends and colleagues at AIMCo the best of luck going forward.
And that's our first episode. I'm Alex Zabjek. Thanks for joining us. Absolute Returns is a podcast by the Alberta Investment Management Corporation. Don't forget to subscribe. You can find us on Apple Podcasts, Spotify, or wherever you get your podcasts. Until next time.